Agnico Eagle Mines is widely regarded as the very best gold producer on the planet. This is one of the biggest gold producing companies. They have a very good reputation, and today we're going to do a deep dive to see whether it's a buy or not. Keep in mind, these are just my opinions based on my own research, and you should always do lots of your own research before investing any money at all. Agnico Eagle trades on the New York Stock Exchange under the ticker AEM. The company currently has 11 producing mines, most of which are in Canada, but they also have some exposure to Finland, Mexico, and Australia. But overall, they have a very safe jurisdictional risk profile. And of these 11 producing mines, only 2 of them are Tier 1 mines, and Tier 1 is going to be defined as can produce at least 500,000 ounces a year for 10 years at the lower end of the cost curve. And right now they're producing at a rate of about 3.5 million ounces of gold per year, and they're almost exclusively gold. They produce a tiny amount of zinc, copper, and silver, but compared to their gold production, it's basically irrelevant. And the company has 54 million ounces of gold in reserves and another 44 million ounces of gold in resources, which, combining those two at this production rate with their current recovery rate, that equals about 26 additional years of production with the gold that they've already found. And now I'd like to take a look at Agnico Eagle and see how it stacks up against its peers on various metrics. So here we have the cash flow per share over the last 10 years. Agnico Eagle's in blue, Barrick Gold is in black, and then Northern Star is in green. And you might be thinking, Northern Star, who's that? Well, they're an Australian company who's pretty similar to Agnico Eagle in that they only operate in safe jurisdictions, and they're a pretty big gold producer, producing about 1.7 million ounces a year. So of these 3 companies, Agnico Eagle has performed the best. In the last 10 years, they've about doubled their cash flow per share, whereas Barrick Gold and Northern Star can't say the same thing. But when looking at a company's per share growth over the years, that doesn't tell you how much risk they took on to make that growth happen. So now let's take a look at the net debt to EBITDA ratio of a few different companies over the past 7 years. So here we have Agnico Eagle, Barrick Gold, and Newmont. So we look on the very right-hand column over here, that's the most recent year. We have Agnico Eagle at 0.5, which is significantly better than Newmont at 1.85. However, not nearly as good as Barrick Gold at just 0.22. And now I want to show you how much motivation the CEO of these various companies have to see the stock perform well. And to find that out, we're going to take how much stock they own relative to their annual salary, including bonuses and stock compensation. I personally like to see the CEO own at least 5 times his or her annual salary in stock. But with Newmont, the CEO owns 1.2 times his annual salary. Agnico Eagle's CEO owns 1.7 times, and Barrick's owns 8.5 times. So Barrick blows every other major out of the water in this category. And as a matter of fact, it's a Barrick policy that management must own at least 5 times their annual salary in stock. Now, I believe that's annual salary excluding bonuses, so 5 times their base salary. But that means that Barrick's management is much more aligned with shareholders than the management of Agnico Eagle or of Newmont. And now I'd like to take a look at recent insider transactions, because nobody knows more about a company than the top executives who are there seeing it every single day, and this is all they do. So insider buying or selling can tell us a lot about what top management thinks when it comes to the future success of their own company. Comparing Newmont, Agnico Eagle, and Barrick, Newmont is the worst in this category because there's no buying at all and just selling. Agnico Eagle, there's more selling than there is buying, and Sean Boyd, who's the current chairman and the former CEO of Agnico Eagle, is selling a lot of shares. And then Barrick, there's heavy insider buying and there's virtually no insider selling. So in this category, Barrick wins by a mile. By the way, stick around until the end because I'm going to give you my target price for Agnico Eagle, as well as whether it's a buy, hold, or a sell. And now let's take a look at the company's potential for growth. So Northern Star today is producing about 1.65 million ounces a year. By 2026, they should be at 2 million ounces a year, so a reasonable growth profile there. Agnico Eagle is producing about 3.45 million ounces a year, and they have no growth in sight. In their 2023 annual report, they go over their future production profile for 2024, 2025, and 2026, and there is no growth there whatsoever. And they really have no substantial growth projects in their pipeline. They have some minimal growth projects, but I think that's just more or less going to replace their mines that are dying off or their mines that are getting into lower grades. And then you have Barrick, currently producing about 4.9 million ounces of gold equivalent. Some of this is copper, most of it is gold. And it looks like they're going to grow that number to about 7 million ounces of gold equivalent by 2030. Barrick has an enormous pipeline, and those are just the growth projects that are already planned and already in progress and are happening. However, in addition to that, they have other enormous growth projects as well. For example, their Donlin project in Alaska, they own 50% of it, and that mine is going to be producing about 1 million ounces a year. And then you have their Pascua-Lama mine, which in fairness has had some major problems along the way, but if that ever gets into production, that could be another 1 million ounces a year. And then they have their Reko Diq project in Pakistan, which in terms of gold equivalent is going to produce like 2 million ounces per year, but they only own 50% of that, so that's 1 million ounces of gold equivalent attributable to Barrick. So Barrick has by far and away the best growth profile of any major. The biggest factors for their share price is number one, that there's no major problems at any of their mines that gets the mine shut down temporarily or permanently. Some kind of disaster, whether that's seismic activity or a tailings dam failure or something like that. Now the company is pretty safe in terms of jurisdiction, but this is mining and a lot of things can go wrong in mining. But the next thing that's really important for their share price is keeping costs low and making sure that the increase in costs are less than the increases in the gold price. So the gold price is probably the single biggest thing that's going to be affecting the share price of Agnico Eagle. But if the cost increases exceed the gold price increases, well then we could see the share price come down. And then I think one that's often overlooked but is a huge deal for the profitability of Agnico Eagle is the strength of the Canadian dollar relative to the US dollar. So if the Canadian dollar goes down relative to the US dollar, all else equal, the stock price is going to go up. And Agnico Eagle over the last couple of years has benefited from this a lot because the Canadian dollar has been weak relative to the US dollar. So if that reverses, well, that could negatively affect the stock price by quite a bit. So if you're an owner of Agnico Eagle stock, keep a close eye on what the Canadian dollar is doing. And if you're wondering why that is, it's because the company sells their product in US dollars, but a significant amount of their expenses are in Canadian dollars. So when the Canadian dollar increases, well then their costs increase, and the opposite happens when the Canadian dollar decreases. In order to put some kind of valuation on this company to figure out what the stock price should be trading at today, we need to look at the pros and cons of the company to determine what kind of cash flow multiplier it's going to get, because the cash flow multiplier is key in determining the company value and therefore the stock price. First up, let's go over the pros of the company. Number one is that they operate in mostly safe jurisdictions. And secondly, they're one of the lowest cost producers. They have low leverage, meaning how much debt they have relative to how much money they're making is pretty reasonable. And I think one thing that has really helped the company is that they're laser focused on Canada. So they're really great operators in Canada. They know the suppliers, they have a great workforce, and also they've become really adept at working in that type of climate. So the fact that they're so focused on Canada and have been for many years, I think has helped them maintain reasonable costs and also achieve a history of per share growth. So their per share growth has been impressive over their long history, and because of that they're able to pay a nice dividend, and they've been paying that dividend for many years. And they have huge reserves and resources. At the current mining rate, we're at a whopping 26 years, which is very, very impressive for a gold producer who doesn't also have significant copper exposure. This kind of reserve and resource life is much more common when a gold producer is also producing copper, because those are often coming from gold copper porphyries, which tend to be massive mines. So the fact that they're doing this without those massive gold and copper porphyries is pretty impressive. And now for the cons of the company. First off, they have no growth profile. I'm typically not a fan of investing in a gold producer that doesn't have a way to grow, because in order for me to make money on the stock, I'm dependent on the gold price going up faster than the mining costs go up. But when a company has a nice growth profile, let's say they can double production over the next 5 years, well, in that case, even if the gold price goes down, or even if the mining costs go up quite a lot, well then I could still make money on the stock if they can deliver on that growth. So the fact that there's no growth, I don't like that at all. And then you have insider selling exceeding insider buying. And also something I think that's going to hurt them in the market is that they're moving away from gold. They say in their annual report that they're exploring other commodities as well. And recently they went into a joint venture with Teck in Mexico, where they're committing to spending almost $300 million on a project that has nothing to do with gold. So I think that expansion outside of gold is actually going to be bad for the share price. And of their 11 producing mines, only 2 of those are tier 1 mines, and the other 9 are either tier 2 or tier 3 mines. So compare that to Barrick, for example. Barrick is almost exclusively tier 1 mines. And as Rick Rule likes to say, all mines have surprises, but with big mines, you generally get good surprises, and with smaller mines, you generally get bad surprises. So in terms of that, I would like to see them have more tier 1 mines than they do. And next is it's taking them a lot of capital investment to maintain production and keep costs reasonably low. Now, I'm not saying they shouldn't make these investments, because I think they should, but considering how much money it's costing them to just maintain production, not even increasing production, is a little frightening. In 2024, their CapEx is scheduled to be nearly $2 billion, $1.76 billion on CapEx, just to maintain production and do some projects to help keep costs down. Compared to how much money the company is making, that is a significant amount to spend. And then the final con I have here is their troubling reserve reconciliation at Fosterville. So their Fosterville mine in Australia is by far their lowest cost mine, because this mine is so high grade. And in 2023, this mine produced nearly 300,000 ounces. I think it was about 280,000 ounces at a very, very low cost. However, as they got underground, they figured out there's not as many ounces here as we thought, and they had to reduce the amount of reserves there. And because of that negative reserve reconciliation, in 2024, they're going to produce a lot fewer ounces at their most profitable mine than they did the year prior. And with all of that, considering all the pros and all of the cons, I'm going to give AGNICO EAGLE a 10 times cash flow multiplier. So with this number, let's go figure out a valuation and a potential share price. Our next step to valuing this company is to look at the company's cash from operations going forward in various gold price environments. So over here on the left-hand side, we have what the gold price could possibly be. We have 2,000 on the low end, 2,500 per ounce on the high end, and then today's gold price of $23.25 in the middle. In 2024, the company predicts their all-in sustaining cost, what it costs them to produce an ounce of gold, after taking into account byproduct credits. So they take their costs to produce an ounce of gold minus what they get from their little bit of copper, a little bit of silver, and a little bit of zinc. And then we get $1,125 per ounce at their midpoint of guidance. And their guidance for production this year is 3.45 million ounces of gold. So what we do here to figure out this cash from operations number is we take the gold price, $2,000 an ounce, minus the all-in sustaining cost, and that gives us $875 an ounce. That should be our cash from operations per ounce in 2024, we multiply 875 times 3.45 million ounces to get us cash from operations of about $3 billion. If we jump up to today's gold price, we're looking at $4.14 billion, and at $2,500 gold, we're looking at $4.74 billion. So using these numbers, let's figure out a company valuation and an appropriate share price. This right here is going to be our formula to determine our enterprise value and our share price. So we're going to take the cash from operations, this number right here, minus other operating expenses and minus net interest expense. We're not subtracting general and administrative expenses here because that was already taken into account to figure out our cost from operations, because that's already included in their all-in sustaining costs. So we're going to take that number and then we're going to multiply that times our cash flow multiplier, which is 10. And then from that number, we're going to subtract our net debt. So that's going to be plus cash minus debt. And that equals our enterprise value, what the company is worth. And then to figure out the share price, we divide it by the number of shares outstanding, and then that's going to be our number for the share price. So let's take this formula and do it together at a $2,000 gold price. So our cash from operations is $3.02 billion. Our other operating expenses is $83 million. You can find that in the 2023 annual report. They give you their estimation for 2024 operating expenses. And then we're subtracting the net interest expense of $133 million. You can find this in their financials. What I did is I took the most recent number of their net interest expense from their quarterly financials of Q1 2024, and then I multiplied that times 4. We then take this number and multiply it times 10, our cash flow multiplier, to get $28.04 billion. And then we take that number and we subtract the net debt. So that brings our enterprise value to $26.58 billion. And remember, this is at a $2,000 per ounce gold price. And then to find our share price, we divide our enterprise value by the number of shares outstanding, which is 505.1 million shares. Again, you can get this information from the annual report. And then our share price is $52.64. So that is lower than today's share price, but that makes sense because that's assuming we have $2,000 per ounce gold. And in a moment, I'm going to repeat this calculation using a gold price of $23.25 as well as $2,500 per ounce. So at today's closing price of $68.50, I'm going to put the risk level for this investment at a 6. Now this is 1 through 10, 1 being the safest, 10 being the most dangerous. And 6 might seem pretty risky, and it is because 5 is the lowest number I will give to a gold producer, because gold mining is a very risky business in general. And since we don't have a big margin of safety here, I'm raising the risk level a little bit to a 6. And our verdict here is going to be a hold, because I don't think we're getting a big enough discount to justify the risk you take buying a gold miner, because there's a million things that can go wrong in the mining business, even if you're in safe jurisdictions like AGNICO EAGLE is. And as you can see here, I did the math using that same formula to come up with an enterprise value at these various gold prices and a fair value per share at these various gold prices. So our target price here, based on today's gold price, is $74.80, which is higher than today's gold price, but that's only an 8.5% margin of safety. And I'd like to see a margin of safety much higher than 8.5% in order to buy a stock in the gold mining sector. So with that, overall, this wouldn't be my first choice. If I was looking for a major to buy today, it would be Barrick, because management is much more aligned with shareholders. There's heavy insider buying and very little insider selling, and they have an excellent growth profile in the coming years. Yes, you do take more political risk with Barrick, but you're also getting it at a cheaper valuation than you are with Agnico Eagle. So I think it's a much better buy today than Agnico Eagle is. But I can't argue with the people who say that this is a very high quality company, because it is. I just think it's fully valued today. And if I had a big position in Agnico Eagle today, I might even consider selling some of my shares, as I don't see a lot of upside remaining here, whereas with many other gold producers, I see a ton of upside. If you like my work here, consider subscribing to my newsletter by clicking this link right here, and next watch the video where I do a deep dive into Alamos Gold and a deep dive into B2 Gold, and I'll see you over there.